Choosing the right Kiwisaver fund to invest in can be a difficult task. Each fund will promote its high returns and low fees, great customer service, and how green its investment book is. Many times, it's all marketing fluff. In this video, I'll be sharing the most important attributes to consider when choosing a Kiwisaver provider and fund. And at the end of the video, I'll be sharing some of the top funds that meet these factors. Choosing the right fund has a huge bearing on the amount you'll have stashed away at retirement, but it is also highly dependent on your personal situation and goals. This video is meant to be educational in nature, and for specific advice on your personal financial situation, it's best to get in contact with your provider or an authorized financial advisor, as they can offer tailored advice. If you haven't already, please make sure to subscribe to my channel down below to keep up to date with all my future content in the personal finance and investing space. Let's start by explaining the Kiwisaver system. Kiwisaver is a government-run savings initiative in New Zealand that aims to help individuals save for their retirement. It is a voluntary savings scheme that offers various investment options to suit different investment objectives and risk profiles. Issuing these various investment options are Kiwisaver providers who manage the funds and make investment decisions on your behalf through their funds. This includes the likes of Milford, Simplicity, ANZ, ASB, Mercer, and the like. It's important here to highlight that they will be the ones managing the money, not the government. Simply, the government creates the rules within which each of these fund managers must operate. Each provider will issue funds to the market, each with a different proposition to investors depending on their risk profile. Lower risk funds, which mainly invest in safer cash and fixed income instruments, are called defensive or conservative funds. Those that invest on the other side of the spectrum in riskier stocks and property, for example, are called growth or aggressive funds. Those that are in the middle are usually called balanced. As the saying goes, generally a higher risk fund will have greater returns when compared over the longer term. As a member of Kiwisaver, you can invest 3, 4, 6, 8 or 10% of your gross pay into the fund. Employers are required to match your contributions up to 3% by law, but this can be greater if they opt in. Additionally, the government will contribute 50 cents on the dollar for the first $1,042 you contribute each year. So essentially, you get $2.50 for every dollar you contribute up to about $1,000. That's not a bad return. There are 3 ways you can withdraw your money from Kiwisaver at some point down the line. First, you can withdraw the whole amount as a lump sum when you turn 65. Secondly, you can withdraw everything in your account, leaving $1,000 in the fund when you purchase your first home. And lastly, you can apply for a hardship withdrawal in the case you're in material hardship. However, the threshold for this is very high. Choosing the right fund is essential, as over a 45-year working life, the difference between a conservative fund and a growth one can be tremendous. Let's consider the case of a 20-year-old earning $70,000, getting a 3.5% pay bump each year, and with a starting point in their Kiwisaver of $10,000. As you can see here, at age 65, this individual would have $678,562 by investing in a conservative fund. Not bad, right? If instead this individual was invested in a growth fund, not a conservative fund, as you see here, they would have over $400,000 more in retirement. So choosing the right fund is critical. Let's now discuss the main factors to consider when choosing a Kiwisaver fund. The first thing you'll want to do is assess your timeline. Have you bought a home yet? Will you use your Kiwisaver funds to do so, or are you saving right now all the way through to retirement? These questions are important to assess how long you've got before you need to withdraw your funds. Investing has its risks, and investing over longer time periods can be more forgiving. For example, if you bought Meta stock 10 years ago at $28 each, today it would be worth almost 8 times more at $212 per stock. So over the long term, or LT here in the graph, the investment has been a pretty good one. If instead you bought the stock in September 2021, when the price was well over $300, and withdrew the money upon buying a house or retirement, say at $200, you'd have instead lost a whole lot of money in the short term, which is shown here by the ST on the graph. Sorted has a great infographic on their website here, showing the time spans they recommend for different fund types. And that brings me on to my second factor to consider, and that is your risk tolerance. Everybody has a different tolerance for risk. As was mentioned earlier, there are different fund types catering to different risk profiles. Using the sorted chart again, in the first and second row you can see the risk level and price fluctuations you can generally expect from different fund types. Most providers will name their funds according to their profile, as you see here for Milford Asset Management. The third factor to consider are the returns the fund has generated over previous years. We shouldn't expect these returns to continue into the foreseeable future, as they could have a change in staff, they lose their knack for finding good opportunities, or they might have got lucky in the past. However, it does show their abilities, especially when evidenced balanced over long time periods to manage money effectively. The fourth factor is fees, which are unfortunately a huge drag on Kiwisaver returns. In 2022, according to the Financial Markets Authority, Kiwis paid over $690 million in Kiwisaver fees for doing what should be a pretty straightforward process. It is still not unusual to hear of fees above 2 or even 3% a year in Kiwisaver, so it's important to keep these low so you build your own wealth and not your bankers. The fifth factor to consider is the service your Kiwisaver provider offers. Just last week, Consumer released a report on banking and Kiwisaver consumer satisfaction for 2023. Winners out of this included Simplicity, Milford Funds, and Generate, with the three providers being winners in prior years also, showing they consistently provide good service for their customers. Sorted conducts a 6-monthly survey and shares a view out of 5 for each fund on their website. Doing your own research and checking with friends and family can be a useful gauge of whether a provider is a good match with what you're looking for, as no two are the same. And finally, the sixth factor to consider is the quality of their investments according to the ESG principles. With 3 or more % of your salary going into Kiwisaver, you want to make sure that it's going into investments that align with your values. I made a video about this in the past. Mindful Money is a great resource here, and they highlight some bold facts. Over $2.7 billion in Kiwisaver funds are invested in companies involved in fossil fuel extraction and production. Over $270 million is invested in companies manufacturing weapons, and $2.5 billion is invested in companies that test their products on animals. Mindful Money has evaluated nearly every Kiwisaver fund, and they have put together a list of funds that meet their self-defined high ethical standards. Scrolling through their list, there's a few familiar names including Booster, Generate, Mass, Mercer, and Simplicity. Now let's take a look at some funds. For each factor I've outlined, I've found a single fund that exhibits these traits. These funds are not a recommendation. I'm simply providing examples based on publicly available information using third-party judgments. Before making any investment decision, it always pays to check in with a financial advisor for a professional and tailored opinion. The first factor was timeline and risk. Here I've pulled up ANZ's 6 Kiwisaver funds, which are each named after their risk profile, from the higher risk growth fund to the lower risk conservative and cash funds. Under their names, ANZ provides a picture of the timeline the funds are suitable for. They suggest the growth fund is good for those investing beyond 30 years, while the conservative fund best suits those looking to withdraw their funds within the next 4 years. Under that, we have the investment mix. Think of growth assets as those that go up in value over time, such as stocks and property, while income assets are those that earn money over time, like putting cash in a savings account with a bank and earning interest. So if you have a longer timeline and are open to having more volatility in your Kiwisaver fund, the top row might be a better fit. While if you have a shorter timeline and are hesitant to take risks, the bottom row of funds might be a better fit. The second factor is returns, with an example of this being the Milford Kiwisaver Active Growth Fund. This fund has been around since 2007, has over $3.5 billion invested, and since inception it has realised a return of 11.59% as of March 2023. Sorted has compared the fund's returns after fees and taxes against other growth funds. As you see here, this comes to 7.41%, while the industry average is just 4.43%. On the stock side, some of the largest holdings right now include Contact Energy, Visa, Coca-Cola, Boston Scientific, and Shell. And in terms of their bonds, the largest are with large banks such as NatWest, CommBank, and ANZ, and corporates such as the Scentre Group, Brisbane Airport, and Woolworths. On their website, Milford state that they recommend an investment timeframe of at least 7 years, and this fund carries high risks. So this is a clear example of a fund which provides a high return to Kiwisaver investors. The third factor is fees, with an example being Kernel High Growth Fund. This fund was started about a year ago, and as of the end of last year, had over 500 investors and 15 million under management. And as with most Kernel funds, their fees are kept really low, at just 0.25% per annum. This comes to just $25 a year for every $10,000 invested. Comparing this to the industry average of 1.04%, this is around 4 times lower. This fund invests in mainly growth assets such as stocks and property from New Zealand and around the world. With a 98% weighting towards these growth assets, this is what's called an aggressive fund, which is towards the higher end of the risk spectrum that we covered earlier. The companies this fund invests in includes well-known names such as Apple, Microsoft, Amazon, Google, and ExxonMobil. Through this fund, you have access to invest in some of the world's largest companies for what is a comparatively small fee in the Kiwisaver world. The fourth factor is service, with an example of this being the Simplicity Growth Fund. This fund was started in 2016, has over 50,000 investors and 1.7 billion invested, and it has a relatively low fee of just 0.31%. As we covered earlier, Consumer gave Simplicity, alongside Milford and Generate, its People's Choice Seal of Approval for customer satisfaction and industry performance. Sorted has also given the fund a 4.5 out of 5 for their communication and investment help offered to clients. In terms of where this fund invests, as a growth fund it is heavy on shares with 77% invested there and the remaining 23% invested in cash, bonds and property. Much of this is placed with Vanguard and ethically conscious funds, but some is invested with local firms including Fisher & Paykel Healthcare, Spark, Auckland Airport, Meridian Energy and Infratil, among others. The fifth and final factor is the quality of investments made, and while many funds are increasingly moving their funds away from controversial industries, Pathfinder's Growth Fund has made this central to its investment focus. It was created in 2019, it has over 4,000 members and $140 million invested, and over the past couple years it has performed reasonably well as compared to the average among growth funds. To investigate the quality of investments of most funds in New Zealand, Mindful Money is a great resource. As you can see here, there are a few areas of concern with Pathfinder's investments. However, compared to most funds, the volume of these are relatively minor. Their largest investment holding at this time appears to be cash and term deposits. However, among their largest holdings is Microsoft, Infratil, Telstra, QBE and EBOS stock. The fund mainly invests in shares and property at 60 to 70%, with the remainder in cash and fixed interest investments. So I hope you enjoyed this video, and if you did, please make sure to subscribe to my channel down below to keep up to date with all my future content in the personal finance and investing space. Thanks for watching, and I look forward to catching you on the next one. Cheers.